But you're assuming that the typical homeowner
I
is
didn't say
disciplined.
typical. I'm telling you, you got to be disciplined in order to do it for it to make sense. So for me, I see it as a wealth hack, right? Most people are just scared to be in debt. But look, I'll tell you right now,
It's like the 3-year arms
my
from 20
parents
years ago.
probably
Oh,
still,
take a
my
3-year arm,
parents,
invest the difference.
bro, my parents probably still have a 30-year mortgage, to be honest with you, right? They've refied so many times. This is America that we live in. Let's call a spade a spade. What is up, everybody? We are back again with another segment of the Liquid Lunch Project called Relationship Capital, where I bring in and Luigi brings in people from our network so you can get to know them a little bit better. Right now, I got my buddy Alex on. What's going on, Alex? How are you?
I'm doing good, Matt. How are you?
I'm doing well, my man. So why don't we just get started here? Why don't you tell us a little bit about SPG Capital so the audience gets a little bit of background? I know me and you've known each other for a while.
Sure. Yeah, no problem. So, SPG Capital is a private fund that we started that basically invests people's money into loans that are backed by real estate. It's pretty simple in those regards. So, we raise money from private individuals that are looking for a good, stable return on their investment, and then we go and then we invest that money into first lien, mostly residential real estate loans. So these are people that are doing fix and flips. They're doing rental value adds, and then cashing us out with with a bank, and just going from there. We built a great community, in the tri-state area. We're based out in the Philadelphia area, so we lend across the tri-state area, and we built a great community that comes together and really does great projects. And our top goal is always to just give our investors timely, stable returns every month that makes them happy and lets them accomplish whatever they want to do with their investment returns.
No, I think that's awesome. There's definitely a place for that in people's portfolios as well. You
Mhm.
know,
Yeah.
so you guys are only on the debt side. You're not buying any houses. You're not trying to flip anything yourself. You're just lending money to people that are out there doing this.
We so we still do our own projects. So it's disclosed to all of our investors that if the certain deal comes across our desk that we want to take on, we can use some of those funds for that if we so choose. So we're still active investors. We still have a rental portfolio of our own, and we still do a handful of fix and flips and whatever type of acquisitions come our way throughout the year from some of our strategic partners.
Hmm.
Um, and But the main business model of SPG Capital is the debt side, for us to grow and want to grow that side of the business.
So are you guys, how are you guys structured right now?
So we're a 506c. So we're a private placement fund, where basically we're just marketing out to our current investor database and trying to educate people on what we provide.
Hmm.
um, it's a good fit for some people, it's a good fit for not, and that's perfectly fine. We know that. Again, we just believe that, like you said earlier, that it's a good part of everyone's portfolio. But that's how we're structured on the legality side. What did you have another
Yeah,
kind
well, so
of
no,
part of?
yeah, I want everybody to understand that you are actually a 506c fund,
Yeah.
right? So it's
Yep.
you guys are registered with the SEC. You're not
Yeah.
just sending money to, Sam Smith down the block that's going to say, "Let me put it into this deal." You actually know where it is. You're going to get a PPM. You're going to get a prospectus, right? And I want to make
Absolutely.
sure, everybody that's listening right now knows that the people that we do bring on here, we're doing a lot of due diligence on to make sure that's part of it because we don't want you to go out there and invest blindly. With that
Absolutely.
being said, in your fund, what are you paying a set interest rate, or is it
Yeah.
what's the IRR look like? Are there points in the back end? Because everybody structures it a little bit different.
Yeah, no. So we're a strict fixed rate. We tried to keep it as simplistic as possible. for people to just wrap their head around and just understand. So basically, we have two classes in our fund right now. So to commit your money for 1 year into our fund, we'll provide a 9% return annualized that's paid out monthly. And
Okay.
then if you want to commit for 2 years, we'll give you 10% annualized that's paid out monthly.
Wow,
Um,
you guys are paying out monthly. Most people are only doing it quarterly, so
Yes,
that's a
yes,
big
we
benefit.
get monthly distributions. That's we try to make that our attractive trait really. It's like, hey, like
Keeping your bookkeeper busy.
yeah, exactly. For sure. Our back our we have a good system set up on the back end that, tracks that very well, and it's like clockwork for us now, which is good. But
And so
yeah. So
you guys launched this in 2023. How much money have you guys raised to date?
We have close to 7 million raised in the fund
Okay.
right now. So the way that we got into it was we were aggressively buying real estate in probably from 2019 to 2022. We were trying to acquire as many rentals in our market as we could, doing fix and flips, all the above. And then in 2023, our deal pipeline got dried up quite a bit. So we raised private capital for all of the acquisitions that we did before that. So
Hmm.
all of our rentals, all of our fixed, we've always raised private money. So we had private investors that kept asking us, like, "Hey, Alex, I have, when's the next project? I have money to invest." And we had to keep telling them, like, hang tight, like we don't have anything right now. We'll be in contact when the next project comes about. So we didn't want our private investors to go park their money elsewhere because
No,
it was getting
listen, it's that's a big thing, man. Most people don't realize, yeah, I'm going to go out and raise this money, but you got to put the money to work, and you got to know how
yeah,
long that money is going
gotta
to sit
have it,
idle for.
gotta have it
Because
turning. I mean, that's how money likes to be,
exactly.
used. That's how you make
Because
money off.
every day that money's sitting idle and it's not working for you, it's a missed opportunity. And I don't think most people realize that.
Yeah,
Especially, there's even some people that raise money and they don't realize, yeah, I just raised this money. Well, if you're not going to put it to work, you're not going to hit your
right.
projections. If you don't hit your projections, your investors are going to wind up leaving you.
Absolutely, 100% on that. And we were raising from, mostly entrepreneurial type of people that, were, savvy enough to, we thought they would realize that. And again, they would have to, put their money somewhere to get some type of return on it. So when that situation came about, me and my partner were just kind of, talking it out, see what we want to do. And then we started to listen to a couple people. We have a couple people in our network that do what we do now, and we talked to them about it. So in the beginning, we tried we just did a direct placement model. So basically, we just put the money directly into the borrower's deal. So we
Mhm.
were just the middleman of just connecting the two. And we just collected the point spread.
Yep.
Um, so we did that for a couple deals, and we saw like a good proof of concept. And then that's when, at the end of 2023, we liked the fund model the best for what we wanted to accomplish, and that's when we started to set it all up. Get the attorney involved, draft all the documents, and get registered and all that good stuff.
I love it. So, like, we never spoke about this, but like, what did you do prior to this? What were you doing?
Real estate, same thing.
Oh, so you
Just
just
like
did same
just
real
buying
estate?
rentals and flips. I mean, when I first got out of college, I got a financial advisory job. Like I passed like my Series 7, Series 66, like all that stuff. I was gonna sell, investments and life insurance and stuff. And I always wanted to do my own thing. I'm just like, I'm young enough where like I don't have, a lot of, dependents or, bills and whatnot. I'm just gonna take the jump and just go for it. And it was tough in the beginning, obviously, like any other person that takes the jump and on an entrepreneurial journey, and had some bumps in the road, but just stuck with it. And obviously, the snowball started to take effect. A couple years later, and here we are now.
So the market today, the real estate market's tough in a lot of areas, right? You have houses declining in some places. There's oversaturation. We had Trump that just came out and he's proposing a 50-year mortgage. What are your thoughts on that?
Specifically on the 50-year mortgage.
Yeah.
Yeah. I think obviously you see a lot of things like on the internet that are like blowing it like so out of proportion. It's like ridiculous.
Mhm.
Because like if you really like do the math, like it's actually like not that big of a difference, because I don't think what people realize is like when you amortize it for longer, it's like the interest portion is still like so um stronghold on the front end of your note that like your payment is actually only differentiated by like a couple $100 a month. Now I get
Yeah.
it, for some people like that's a lot, and that makes a difference, for qualification and stuff like that. But I mean, again, if you just look at the actual like amortization table and everything, like it's you
Well, yeah. I mean, it's going to take a longer time to build equity. Lou, I want to get your thoughts on it. What do you think about it?
It's a couple of $100 a month, but it's a couple of $100 a month compounding for 50 years.
Mhm.
I mean, compound magic. What did the Oracle of Omaha say? It was the eighth wonder of the world.
Yeah, you're right there.
Listen,
Yeah. No,
I'm going
it's
to
what scares me about the 50-year mortgage is it's changing the dynamics of the American dream, right?
Mhm.
Because if the typical white picket fence homeowner is getting older, and that average first time buyer, instead of being 26, is now 36, well, 36 plus 50 is 86. Wow.
Yeah.
listen, I'm taking the other side of this one. I'm going on the other side. Okay. People freak out. They say 50 years, I'm going to be in debt for. I'm never going to get out of it. It's really not the case. How many people do you know take a mortgage out? They refi, they pull more money out of it. Their mortgage
Yeah.
extends anyway. That's
Right.
point one. Point two is, all right. So if we're going 50 years, there's a high likelihood that the interest rate is going to be higher, right? So if you
Yeah.
take the average $400,000 house, it's at 5.5%, right? Your mortgage is going to be somewhere around $2,270 a month. Okay. Now, if you take that same $400,000 house and let's say the interest rate's 6%, you're going to be somewhere around $2,100 a month on it.
Mhm.
Not a big difference, right? About $200. Okay. That $200, if you take that $200 and let's say you get a modest return in the stock market, but you invest that over time, you're going to have $900,000. Plus, you'll
Yeah.
have 3% appreciation in the house.
But you're assuming that the typical homeowner
I
is
didn't say
disciplined.
typical. I'm telling you, you got to be disciplined in order to do it for it to make sense. So for me, I see it as a wealth hack, right? Most people are just scared to be in debt. But look, I'll tell you right now,
It's like the 3-year arms
my
from 20
parents
years ago.
probably
Oh,
still,
take a
my
3-year arm,
parents,
invest the difference.
bro, my parents probably still have a 30-year mortgage, to be honest with you, right? They've refied so many times. This is America that we live in. Let's call a spade a spade,
Here,
you know?
here's what I see. I think it's just gonna widen the gap of like who's the educated and who's the not, on these things. Like that's where I think it's gonna widen the gap of like the poor, middle class, and then the wealthy, because again they're just gonna announce like 50-year mortgages and whatever, and like people are just not. They're still not gonna just like educate themselves more about like, all right, like what does this actually do for my budget, my finances, or whatever. They're just probably just gonna take it because, like, again, like people were saying online, it's like, oh yeah, well you could take the 50-year mortgage and just like pay it down faster, and put more towards your payment. I'm like, dude, no one, like,
Nobody
no
does that. Nobody
American
does it. Sounds
do that.
great in theory.
No one's gonna do it. Like if you like,
Alex, however, if
you'll
you
find to
have
spend that money somehow. Like you'll find a
no,
way.
but Alex, if you have a group of young persons that are forever renters and you can get a portion of them to buy into that 50-year program, you're moving the needle as far as new housing startups and
Yep.
durable goods. You got to buy refrigerators, you got to buy
Yep. Yeah.
ovens and microwaves and garage door openers. So that could help.
So
You know what I would love to see? I would love to see Fannie and Freddie figure out a way of making all these notes assignable. Because I think that would move the needle. Because if you've got a baby boomer who's got maybe 8 or 9 years left, and he or she would be able to assign that mortgage to Alex,
Mhm.
that could be more interesting than creating this novel 50-year product.
That's already happening, and there's sites on the internet where you can you can buy an assumable mortgage, but most banks don't have assumable mortgages, right?
Yeah.
'Cause why
Yeah.
wouldn't I go buy a mortgage? I'll pay up more for the house if I can get my rate to where mine is at 2.5%,
Correct.
right?
Right.
So that would
So
be huge if they would allow that, right? But I mean, I guess it's the credit risk and everything else involved. But I guess it's going to depend on how much of a balance is left in order for the banks to be able to accept that.
I think it's just going to come down to if it ever gets passed or whatever. I think it's going to come down to like the same thing. We're still on that same trend. It's just like whoever owns, like the people that own assets will get farther ahead, farther ahead
Yeah.
with the programs like that. The people that don't are going to get farther behind, farther behind. Like it's just that's the way the economy is moving towards right now, with everything, and that I see, all the policies that are being looked at and trying to get passed and all that stuff. It's just now more than ever there's everything in God's green earth on the internet that you can look at to give yourself the chance to get ahead, with your finances.
No, absolutely. And to your point, right, we are in, I mean, it's all over CNBC. You hear it, the K shaped economy. The people that do own assets and have money in the stock market, they're doing fairly well right now. While people that didn't accumulate any assets, right, they're not doing so well right now. So there is that big, great divide that we see. And I will tell you this, though, I'm all for the 50-year mortgage because I think what's going to wind up happening is you may not build new houses in New York where Luigi's from because the price is too high. But over here in Florida, the average home price is somewhere around that $400,000 area.
Mm-hmm.
So what's going to wind up happening is I think Florida's set to skyrocket because we got that communist in New York that's driving people out right now. Then we
Right.
have this 50-year mortgage coming into place. And if DeSantis, my mouth to God's ears, if DeSantis gets rid of property taxes, Florida's
God.
going to boom. It's going to
No.
explode. It's going on the
Yeah.
ballot next year. So
Yeah.
I'm taking as many 50-year mortgages as I possibly can if it
I'm
gets
with
released. I will tell you that.
God, I'm with you. Yeah, I mean, again, like it's like, and it's going to be interesting of like how that equates to like us as investors too. It's just like, well, like what's that going to look like for like what are local banks now going to offer if that like comes out? Like what's this bank going to offer? What's DSCR going to look like? So it's going to change the whole game in that type of sense. Like with,
It's
um,
it's not going to affect you that much. And let me just explain it to the audience a little bit. It won't affect Alex in this fund because the people that he's working with are professionals that aren't going to banks. And the reason they don't go to banks is one, they ask for a lot more documentation, even though
mhm,
Alex still does his homework. But two, Alex's money can fund a lot faster than the bank can move.
yeah.
Right. So that's why Alex will always have um, clientele, even if interest rates drop all the way, there's always a need out there for that
Well,
$100,000,
yeah, I mean, our
$1 million.
clientele are people that, like again, like this is their bread and butter full time gig. They're building big rental portfolios. You know, they give us, a deal to look at on November 15th, and we're funding it on December 1st.
Yeah.
It's rinse and repeat for us, and we deal with just really good operators. I mean, like we don't lend to a lot of like newbies that are getting in, because again, like we don't sell off our notes. We manage all of our notes in house, and we have investors that trust us a lot, and go from there to give them the best return that we can give them, that what class that they're in, and make it successful that way.
You know, I'm wondering right now. Look, the market's at all-time highs. The Dow hit over 48,000 for the first time. Okay. Right now, we're in bubble talk. We're probably going to be in bubble talk for the next couple of years. But I'm really wondering how much of an inflow you're seeing into your fund right now, especially because the market's propped up by mostly retirement accounts out there. Okay.
Mm-hmm.
And a lot of people, especially business owners, don't understand how they could buy real estate in their retirement accounts. So I wonder if you're seeing any inflows from self-directed IRAs or
Yeah.
self-directed 401ks right now.
Yeah. So I would say about I'll say probably like around four. I think 40% of our fund is self-directed funds.
Okay.
So yes, we one of our main job is to definitely educate um, people that tell us that they're interested, to learn more, like obviously about our investment. So when we educate them of like what they can do with it, because like obviously some people like have just like a regular like old 401k from their old job or whatever, and like again it's just been sitting there for so long, and they just like they self-directed is still such like a non-normal like term to like the normal
Yeah,
like
no, I'll tell you why. Look,
and
I spent 17 years on Wall Street. I managed
yeah,
$150 million, right? When
yeah,
somebody asked me what about self-directed? No, you don't want to do that. You got to keep your money in the market. Why? Because we got paid more. The money sat with us, right?
exactly.
If every
That's how you
dollar
get
you took
your
away
feet.
from me was more money out of my firm's pocket and our pocket, right?
Yep,
We didn't want
exactly.
to educate anybody on that. But I will tell you, it's still a hack that most people don't realize,
No,
especially business owners. And for those of you listening right now who don't actually understand what a self-directed IRA or 401k is, it's essentially the same exact thing. If you're a business owner, you have a 401k plan, solo 401k plan set up, or an IRA plan set up for yourself. You can actually move this money to a different custodian that will allow you to invest in different asset classes, not just stocks, bonds, and mutual funds, right? So if you think the market is a little bit high right now, right, and you think real estate, with everything that we're talking about, if you want to be in Florida in real estate, right, if the communist goes into office, which looks like it's going to happen, right? We get a 50-year mortgage for first-time home buyers, okay? And DeSantis gets rid of property taxes. I want to be all in the real estate market. But most people
100%.
don't understand that they can do that if they move their traditional IRA into a self-directed IRA. They can put money with people like you, Alex, or they can actually go out there and they can buy investment properties
Right.
as well.
Yeah, and then again, it's all dependent on like the type of person that's in, how much time that they have, and how much effort they want to put into it. Like obviously the people that we talk to, like our, what we tell a lot of people is like, most of them are just like business owners, entrepreneurs in some way. It's like focus on like what you're good at. You're good at your business, whatever it is. Keep doing that, keep growing that, focus on that stream, and let us put your money to work for you to something that, yeah, you're interested in real estate, you've always wanted to get into it, but is it really the best worth of your time to like try to develop a whole new skill when you got this, business right here, that's working really well, and that you can make X amount of dollars or grow at X amount in the near future. It's like focus on that and let us, do the heavy lifting for you to invest your money into real estate, backed by real estate. So, and that's really
Listen,
our sell to a lot of people.
you're preaching to the choir. Me and Luigi know that most and
Yeah.
best, right? If we like somebody, we think they're a good operator, they have a syndication. I don't want to go and run an apartment building, but I want a piece of it. I want to
Yeah.
be in, right?
Exactly.
So if that makes sense, here, take the ball and run with it. I think
Yeah.
right now in the marketplace, we're seeing a lot of different things go on. Yeah, stocks are at the all-time highs right now, but there's also a lot of talk about allowing traditional 401k plans and pension plans and even regular retirement accounts to go into alternative strategies, right? And you would
Mm-hmm.
kind of be considered an alternative strategy. We call it debt real estate,
Yeah.
right?
Technically an alternative investment. Yeah.
Yeah. So, I mean, unless you're managing hundreds and hundreds of millions of dollars through a REIT or some type of fund that Merrill or Mass Mutual puts together, people usually don't have access to people like you to do it.
Exactly.
Lou, what do you think? I know you're a big proponent of real estate.
I'm curious to see where Alex gets his deal flow from because I think that dictates a lot of where
Glad you
his
asked.
risk aversions go.
Glad you asked. So like I said, I've been doing real estate for the last almost 10 years. Um, we've developed a really good community in our area. I mean, like we've networked for the last 10 years. We've met a lot of good operators and a lot of good people that do good things in real estate, in our area. We never, so our actual problem now is satisfying all the demand that we get from our borrowers that want to use our product. So we actually need to raise more money to catch up to the demand that we have. We need to refer out loans to other either fund or broker to make sure that they get funded because we sometimes run out of money, of our own
Mhm.
funds. So our deal flow hasn't been an issue yet in the last, 2.5 years. Um, the biggest thing with operating a fund like this is always the balancing act of money management. So you need to make sure that it doesn't flip too hard on you where you have too much money and not enough deal flow. Because
Mhm.
there's a thing called drag, where obviously if that money's sitting in your escrow account for too long, then the money that you're actually making from the deals is actually not net profit because that drag is eating it up because you got to pay your investors out monthly at 10%, 10 or 9%. So the balancing act is easy for us right now because the borrowing demand is so high because we just think that we have just really good operators that buy 1 to 2 deals a month and they try to use us for almost every one of their projects and we like know and trust them and that's how we build our business off of is a tight niche community that like know and trust each other and that we know that do good work and have a good operation in place.
Now, are you refinancing properties for people, or are you just working with speculators and fix and
Just
flip
short
properties?
term, short term financing, yeah.
Okay.
Just bridge loans, short term financing,
So,
yeah.
so
We've
what is it?
debated
What is the
to,
typical? So let's say I'm a fix
yeah,
and flipper. I isolate a property, right? What does a typical loan look like from you? Are you going out 24 months, 12 months? Is it 12 and 2? How do you usually operate?
yeah. So right in term wise, it's we're 12% 3 points across the board most of the time.
Okay.
I'm the underwriter. I look at all the deals. I do my analysis. My number crunching and all that. Basically, you send me the address, some pictures, the numbers, and if I agree with all those numbers, then good. We'll give you the money for the deal. Again, it's in our backyard, so I will always, if I'm comfortable with, hey, if borrower one messes up on this project, I know I can just take it over and make it successful because I've done 100 fix and flips before.
Mhm.
So it's like that's an advantage to us also is like we have that like back end like completion strategy like in hand because we've done so many of them and like we're an investor ourselves. But I feel like a lot of these like brokers are just brokers and just like, obviously like they're just
Yeah.
selling their
The
off
fact
and
the fact that you guys actually have done fix and flips, you know what the cost of it's really going to be to fix it.
I
You
know.
know
I mean,
what I
I
mean?
know
How
when
you
a
can get into.
borrower is bullshitting me on construction numbers. They're saying they're going to get them from 25. I look at the pictures. I'm like, dude, no effing way you're getting this
Yeah.
done for 20 grand. Like, so I understand all of that because I've done it so many times. I've looked at so many like projects and ran so many numbers. So that's like second nature to me. But we're 12 and 3. And you know what, Matt? We turn over our money an average of like a loan term is usually only like 4 to 5 months.
So
We
what do
actually
you
write
what?
only 6 month loans with our borrowers.
Wow. So what does the flipper have to come to the table with for you? How much down?
Depends. Depends how good the deal is. It's
Hmm.
super asset based. We know our borrowers well enough. Like I know this borrower has 50 other units and he has, whatever amount of equity. Like I know his balance sheet. They're personally guaranteeing every loan. So I know if, he does anything fishy, like I can go after his other assets. Like again, like I said, we don't really lend to newbies. Like we need to see some type of experience and some type of balance sheet for us to lend to you because we just want to like cover our bases that way. But yeah, it's we will do 100% financing if you are under, let's say 70% LTV. So if you
Hmm.
get a rocking deal and you're like, hey Alex, I got a deal. This deal, it's a 200 grand, 50K worth of work, and the ARV is 400. If I look at those numbers and I agree with that, I'm like, Cool. That sounds awesome. I'll give you the 250 grand. We'll have draws for the construction work. We
Mhm.
always do draws, so we don't, they don't get, full amount of closing, but we'll fund 100% of the deal. So again, very advantageous for people, and people love that obviously because I know personally as a full-time fix and flipper, cash flow sucks a lot of the time. If you got 10 flips going on and you have to put 20% down at the bank for every one of those construction loans, your cash flow gets
Yeah.
eaten up a good bit. So I understand what borrowers are looking for with our loan, and that's how we kind of created our loan product around that because of our own personal experience. So that's what we provide. If it's our first time working with you, we'll never give you 100% financing. You're gonna have to bring some meat onto the table and show us and prove us that you're a good borrower to work with for a couple of those first deals. But yeah, a lot of our business is repeat borrowers. We raise capital from a lot of referrals, just from our current investors, and just building out their organic model that way. And yeah, you know,
That's
we're
awesome, man.
we're growing at a good pace every year, so we're happy.
Alex, I appreciate you being here, buddy, and letting everybody get the inside scoop on SPG Capital and what you guys are doing. You guys are doing a great job. Can you tell the audience where they can find you?
Yeah, so we have a website, just spgcapital.com. Take a look. We got all of our we got our investment opportunities on there, and anything about our company. We have a bio for me and my partner, kind of just tells you the broad aspect of our fund and what we provide. And yeah, there's a book call button. You can book a call with me or my partner Josh. There's a borrower portal for like the real estate borrowers, so they can see like their statement every month and stuff like that. So yeah, go from there. You can Facebook Alex Martyn, Martyn. You can direct message me if you want to talk more about it, anything about our company or just real estate in general. I'm always looking to connect with good, like-minded people. So
Alex, thanks so much, my man. Everybody, that's
thank
a wrap.
you for
That's a
having
wrap.
me.
Anytime, bro. You know you're always welcome. Um,
Yeah.
that's a wrap, everybody. We'll catch you on the next episode. Thanks.